In the game of loans, you either win or you learn. Welcome to the game of loans, where fortunes are forged and empires are built. Your hosts, lords of lending and wholesaling, are here to guide you through the realm of real estate and wealth building. Brace yourselves, cash flow is coming.
Let's just talk about outlook for 2025. Dustin, why don't you jump in and tell us a little bit about, depending on how the election goes, does that impact your business any differently? And what are your plans for next year?
I don't think it impacts my business directly. I have noticed a little bit, and I hate to be one of those people that says, it's been a little slow here lately. This has been one of my slower summers. I have in my Facebook memories last year, I had 17 pending under contract. And I think I've got about 5 right now set to close. But this year is a lot different from last year. Last year, where I was doing almost 100% wholesale, I've got 2 fix and flips going right now, and I've bought way more rentals this year than I've ever bought. So it's actually been my greatest year. I've gained more as far as my net worth. I've also got more in my bank account than I've ever had. So I'm in the positive. I think everybody's just kind of waiting for November. I've got some houses that are just kind of sitting out there right now. Pretty much in my market, everything that's 350 and up is just kind of stagnant. If it's 250, 300, it'll go, but anything up more than that, it's just kind of sitting. I'm hoping to be able to continue to do what I'm doing. So I just Friday picked up another one that we're going to buy and do a fix and flip on. But my biggest goal would be to just add more cash flowing doors with equity, not just cash flowing with no equity. It's got to be a good deal. But that's going to be my biggest, same thing, just rinse and repeat, but just, double it.
So, just with the general outlook, of 2025, interest rates should come down. That'll help you improve your cash flow on your existing portfolio through refinancing the properties. And Steve and I are going to help you take a look at that to see if we can help lower your interest rates and improve cash flow. The home prices, the liquidity below and above 350,000, that's a byproduct of affordability. So if rates go down, more people should be able to afford at the higher price segment, which should unlock another part of the market for you to capitalize on. And then just finding deals with equity and cash flow, that's your business, finding off-market properties and trying to monetize those, create value through renovating them or just finding them at a discount.
Just keep building my brand. Just keep building that up and being the number one name in my market. Right now I am. So I get noticed. What's great is I get noticed out in public all the time. You're the guy that buys houses. So the branding has worked. One thing I am a little nervous about, though, and maybe you guys can fill me in on, though. So, they say they do drop rates, but in turn, that's going to drive the demand up. So, in my opinion, would that not drive the prices of houses up even further, causing more conflict? So, it's great to have, I've got great houses right now that I want to hold on to. I'm like, well, will they appreciate when the rates drop because of the supply and demand? Now it opens up this whole new buyer pool that are going to be outbidding each other.
I'll tell you something when it comes to that. I think in that pocket that you're talking about, right, not the affordable housing market and not the unaffordable housing market, I think there is that lull in the market where a lot of people are between the middle class and upper middle class market, right? There's so much inventory right now that when the rates do come down and it is affordable, I don't think, and you could speak on your behalf because you're one of them holding on to these properties, I don't think that the investors that are sitting in that pocket are going to get greedy and be like, fuck it, I'm going to raise the prices. I think they're so motivated at that point to be able to get rid of those fucking properties that they're just going to get rid of them at market, whatever it is.
Sure.
I do think that in the unaffordable housing market, that's naturally going to, get more expensive. And in the affordable housing, you're going to get a little bit of a tick. But, you could correct me. I don't think in that bubble there's going to be much movement.
It all comes down to a math equation, and there's 2 levers. If rates come down too fast, it'll drive prices up. And there's going to be a period of time where people are going to be able to buy market at a lower interest rate, and then the lower the rates go drives prices up. They'll be the benefactors of more equity, which is why I'm telling people to buy now before rates go down. Yeah. Now, when rates go down too low, we get to a point where a lot of people who are having affordability issues enter the market, which causes an increase in demand, and the supply is not there yet. And it just depends on like what income bracket it falls within. It's going to be, dependent on certain markets. And so I think it's, overall, my guess is somewhere between like 5 and 7.5% appreciation next year, which is very reasonable. Not 10, 20, 30% like we saw in 2021, where rates went from 5% to 2%. I think we'll see rates go from middle of this year around 7.5 down to maybe 5.5, 6%, which is historically a very reasonable mortgage payment. But without wage growth, which is not happening here in the States right now, and if we're going to have higher taxes, which is going to cause another issue with employment and income, I don't think we're going to have a lot of new qualified buyers entering the market. I think we'll see a refi boom where a lot of people are refinancing into lower payments. But are people really going to unlock affordability enough where they're going to re-enter into the housing market? I don't think so. I think it'll help the lower income side of the market, but a lot of people that are in the higher income middle class side, I think they're going to decide to stay, tweak their rate, get into a lower, more affordable payment, and stay put versus just let's go put our properties on the market. It's 2% mortgages everywhere. And then I also unlocked $500,000 in equity in my property to pay for my down payment for the next one. Houses have been stagnant since these people got in, to these houses in the last 2 years with higher rates. So there's no equity to unlock.
Right.
And then, your best bet is to get a lower payment and save a little bit more money so that you can afford to buy in the future. So a big purchase boom, I don't think so. Maybe in the lower income side of the market, you'll see it. Yeah. But I agree. I don't think we're going to see a huge increase. And the luxury market's never interest rate dependent. Those guys are flush with cash. Most of the time, they don't even use debt. If they're using debt, they're borrowing against their stock portfolio for 3-4%. They don't even have to go get a mortgage to buy their houses. Truth. So high end's generally not affected, whether it's a recession or a boom or high interest rates, low interest rates. It's the middle class guys, the real estate investors and lower income, groups that are all affected differently depending on where they operate.
I have a question for you. So where are we going to close out our business, you think, this year? And what's our projection coming for 2025? Like, where do you think we're going to be?
So this year, we'll hit the $1 billion mark by the end of the year, and most of that was done in the back half of the year. We didn't really see an uptick in business until we closed our partnership at the end of March. So it's really been the last 4 months have been, the major months, and we're continuing to see month over month growth. And then $2 billion's the number for next year. We need to go out and lend $2 billion, and I think we have a great chance at doing that. And I think we can even eclipse that, especially with the new team that we just recruited over that was doing $200-300 million a month at one of our competitors. We got some sick stuff in the works right now for an investor. Just a general outlook on the political side of things. I mean, it doesn't really move the needle too much for us, whether it's blue or red at the end of the year. I think if it goes red, it gives us a little bit more certainty that we can push a little harder and we have a lower tax rate and, we can be more aggressive in the market. If it ends up blue, we should still see rates come down. We're still going to see activity on the investor side, but there are some, macroeconomic issues and geopolitical issues that I think can continue to cause some concerns with the stock market and the bond market, which affects our cost of capital in this space. So I'd be a little bit more cautious if the election goes blue this fall. If it's red, it's red means green, blue means red, or at least yellow. Cautiously optimistic. If we go Democratic, I'm bullish. I'm like horns are out and I'm plowing through everything if we go red, especially in a declining interest rate market where we can make bets and do things because we know prices are going to come down for us, where we actually make a bigger spread as rates go down because we originate here and we sell here, but we price it where it is today. And if the pricing rates go down and we're selling a higher interest rate mortgage, our profit margins are bigger. So we can do a lot more things creatively by, aggregating and holding bigger pools and selling them instead of when interest rates are rising, the value of the mortgage that we can sell is less and less. So we need to sell it quick. So we've been selling loans every week, boom, boom, boom. But before rate hikes were going, we were selling loans 60 days. We'd make a spread on our credit lines, sell big packages, get better pricing because we were providing more inventory to the end buyers. But we're actively looking at putting together our own capital to securitize our loans and package them up and manage those assets all the way through, to maturity, or when they pay off both the short-term notes and the 30-year mortgages, because there's income in the servicing and asset management side that we can capitalize on. So 2025, I think liquidity is going to improve across the board. More buyers, more financing, cheaper cost of debt. Investors are going to thrive in 2025 because lower interest rates, ideally prices are moving up. They should have more margin, lower cost, higher profit margin means they can redeploy into more investments. And it's going to be a great refi boom. Anybody who got a mortgage in the last 2 years, game on. Rates are going to be lower. First one to get to them. We're building out call centers. We're hiring massive teams. We're implementing new technology. We're doing all this stuff to get out in front of the refi boom next year. I think it'll hit probably end of Q2, middle of next year. It'll really start to pop. But for right now, we're getting some momentum, and that momentum will help us continue to build up business.
I happen to agree with you. I think, like I always say to you guys out there, like Ras the Boss said, this is the time, and you've said it, this is the time to buy, right? Buy correctly, buy in markets that you know, but go out there, invest, buy, because right now the market is, as much as you guys think it's unaffordable, it's still fucking affordable, right? Compared to what's coming. You could get some really good deals, and then when the rates come down, like you said, and prices go up, like you said, they're going to be able to refinance, get the fucking rate that they want, but they're going to have some equity built up. You've been listening to The Game of Loans, where real estate battles are fought and won. Make sure to fortify your defenses by subscribing. Cash flow is coming, and we'll be back next time to help you claim your throne. The war of wealth continues.